This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
It's interesting the world that we live in and how technology plays a factor. I do think having that data will be critical over the next couple decades. We know the retailers are using this now. I could reference a few kind of interesting books on how these individual stores, really kind of break down all the analytics from how to design a layout of a store that's going to be the most efficient to produce sales. Like this is we get into the marketing psychology side of these. These are really large companies that know their customer and know how to target them specifically. It's pretty in-depth and fascinating if you get to see behind the curtain.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. One of the businesses that we've covered on the show is acquiring these net lease properties. Now, there's a great deal of upside with this asset class, but like anything else, you need the knowledge. And this means understanding the key components of a net lease deal, like everything from the financial side to the physical due diligence and also the financial due diligence, as well as doing a deep analysis on all the property leases. I mean, there's a whole lot to it. Now, our next guest knows all about this stuff and much more. Now, he's a 13-year commercial real estate executive that's completed over 1,000 lease transactions in his career. He is skilled in all aspects of net lease operations, development, construction, management, and leasing. Now, recently, he led a $500 million private REIT portfolio. Today, as the COO of the Liberty Real Estate Fund, he focuses on asset management selections for acquisition, strategic direction of the fund as well. Now, with all that, I'd like to welcome Jason Ricks to the show. Jason, buddy, thanks for coming on, man.
Yeah. Hey, Augustino. Big fan of the podcast. I know you've interviewed a whole bunch of my friends, so thanks for having me here.
You bet. No, happy to have you on, man. Now, guys, if I get Jason has to say, you can reach him via the contact page at libertyfund.io. Okay, Jason, go ahead and tell listeners a little bit more about your journey. How'd you get started?
Ooh, perfect time. 2008. Decided I wanted to get into commercial real estate. I was out of college. I thought, what else? This is what I want to do. My parents were involved in real estate in some capacity. So I thought, this probably fits my personality. Did not know what was going on at the time structurally with the economy, but started off as a broker, did mostly retail leasing, did some sales transactions, did a little bit of industrial and office, but really, really kind of harnessed my skills on the retail side. After being a broker for about 4 or 5 years, I decided, I really want to get into asset management. I'll tell you the reason why. I had to work on a lot of REO business, so a lot of retail properties that were in bankruptcy. So I was working with these banks, and all of these banks had asset managers at the time. So they were the decision makers or the de facto landlord. And it drove me crazy as a broker bringing in transactions that they kind of held all the cards. And I thought, I really want to be in that position where I get a greater perspective of the property itself and have a little bit more of control. So I ultimately moved to Dallas, Texas, and oversaw a very large portfolio of retail properties in DFW and in Oklahoma. So first time managing a team, first time, hiring different agents and really kind of reporting to a very large investor at the time out of California. So I got a lot of experience doing that. And after, 5 years of blood, sweat, and tears in the business, I ultimately learned, I really want to get more on the landlord side as far as the equity side. So, I'm adding all this value as the asset manager. How do I help my individual portfolio for my wife and I. And so that's really kind of what led me into this world of, hey, I want to syndicate deals. I want to own private real estate for all the benefits that I'm sure you and your other podcast guests have referenced, which really led me to where I'm at today, which not only am I an LP in various different funds that I believe in with sponsors you even had on your show, but ultimately, how can I add the best value to investors with what I do? And in particular, that's retail and triple net leases through single tenant deals.
Nice. Excellent. So maybe for those people that don't understand, can you go into a description as to what is a retail net lease? Like, I've talked to other folks. We've had it on the show here as well. We talk a little bit about single tenant net lease and double net and triple net, all this stuff. Maybe you can explain what that is for the audience.
Yeah, sure. So I always use this example of for different audiences, and I know you have really sophisticated folks and others that are more on the learning side for triple net lease. If you were to own a single family home and you were to lease it out to a tenant, you would get a monthly rent from that tenant, which would cover all of these expenses and more. So you still have to, as a landlord, pay the property tax bill, the insurance for the property, and then generally the upkeep, right? If the roof goes out, the landscaping, the pest control, you name it, water heater goes out, etc. But on a triple net lease, that's really covered by the individual tenant themselves. They pay the individual taxes, they pay their portion of the insurance, and then their portion of the common area expenses, which, as far as common area expenses go, think of that as landscaping, general upkeep of the property, pest control, trash, etc. All those little fees that add up, but those get passed through to the retailer. So the advantage is, if those expenses go up, which let's face it, property taxes going up, insurance going up, expenses, additional taxes, etc., that all gets passed through to the individual retailer or to the tenant. That gives you a more predictable stream of income that's easily more forecastable into the future to help your underwriting and give you kind of, in my opinion, a little bit of a hedged investment on that future income stream.
Nice. One of the things that I often say, and everything you said was great, because I often tell people that in a net lease scenario, you're typically you have a longer term lease, and it's these longer term leases are very, very, very predictable in terms of what you're going to get in terms of a return. That's why one of the most appealing parts of this line of business is that if we buy a string of Dollar Generals, for instance, typically we get paid on a monthly basis, right? That's a monthly lease. And you get to distribute that return on a monthly basis, depending on how you set up your fund. Ours is set up in terms of a monthly distribution. And very rarely is that distribution going to change, right? If at all. It depends on the type of the lease and depends on if there's any major mishap, which more than likely there isn't, but you still have some money in reserve just in case. And that's one of the greatest things about that type of asset class is that there is that guaranteed. You can almost time it down to the day as to when that money is going to hit the account, right?
Absolutely, and they're almost like bond leases. So you have the benefits of private real estate ownership, which are plenty, which we can get into. But then you get that predictable income stream, mostly by, let's face it, they're going to be large corporations or very, very large franchisees with deep pockets. And those folks, the rent payment is the least of their worries, ultimately. They want that store to be successful. Again, these properties are in such high demand. If you were to look at all the single tenant net lease properties from a general, again, large view United States, from an occupancy standpoint, it's the highest.
Yeah.
It's historically been the highest. You could even look into 2008, 2009. Well, how did it perform then? Still the highest. I think the occupancy dropped. I've got a chart showing this, maybe 1%. So you're looking at 100 basis points drop from 98% to 97%.
Right.
During a crazy time. I mean, so that just goes to speak to the predictability of that income and the strong underlying businesses that lease from those spaces.
Yeah, yeah, and I would also say that at least more recently, anyway, with these rising interest rates, and we're sitting here in May of 22 currently, rates have gone up significantly. I don't know if it's just me or I've noticed a slowdown in terms of the net lease business, and I don't know, maybe it's because the stuff we're looking at, I'm not really sure, but it's certainly I can see some pressure release off of the cap rates. I'm being able to see that, right? Would you agree, or is that just in my head?
No, I'm seeing the exact same thing. I think it's coming more, if I'm going to be honest, I think it's coming more from the seller side. I'm sorry, from the buyer side. And the reason why is they're talking with lenders. And, if you and I could go place, 3.5% debt with a corporate credit lease, like a Dollar General, and now all of a sudden that's 4.25%, 4.5%, maybe 5%. All of a sudden buying that property to 5 cap does not give the cushion that the lender wants.
Right.
And so I think a lot of sellers are kind of sitting on the sidelines trying to figure out what's going on. And I think buyers are trying to figure out what's going on in the capital markets for debt to determine where they can buy these at. So we're kind of, and this real estate moves much slower than the stock market. It moves much slower than the bond market. But, we're starting to see those ripple effects today.
Hey, Augustino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me. Yeah. Now, one thing you touched on a second ago was how similar these net lease assets are to other types of real estate. And of course, one of these things is the due diligence process, right? So what are you looking for when you're conducting due diligence on some of these assets, and what sort of things are you checking out? Are you looking at the physical? Are you looking at the financial? Both? Like, what sort of things are you checking out specifically and looking for?
Sure, I put them almost into two buckets. One, you have the creative left brain, which is location specific. What are the dynamics of that market? What's the traffic count? What's the signage? What's the parking like? The physical building, is it in good shape? Are the tenants around it? Is that a good place that you want to be? And then you have the more analytical side, which is understanding what the lease is. That's your Bible, right? So what kind of guarantee is it? What type of rights does this tenant have in the lease? Do they have unique termination rights? Do they have right of first offers on other things? Do they have really flexible assignment as subletting language? I don't want to badmouth anyone, but Starbucks is a prime example of this. They have all kinds of flexibility in their lease, which gives them the ability to find a replacement tenant at their choosing. So you have to be really careful with your lease knowledge. And then obviously understanding, is this a quasi triple net lease that has landlord responsibility for the roof, the foundation, for other structural elements? Or is this what I call, an absolute net lease, where the tenant's responsible for the roof and all of the building in its entirety? So there's little different nuances. And I even feel like in the brokerage community, a lot of people miss out on this type of information. Like, they say it's triple net, but between you and me, we know this. It's not a true triple net lease, because I have some maintenance responsibilities. And a classic case would be, I bought one thinking it was triple net. Well, then I had to take care of the roof, and then we had to replace it. Well, the roof, was still $3.50 a foot to replace that thing. That's a big CapEx hit. So you just have to really understand what you're buying, and that lease dictates so much. But again, it's the analytical side of understanding the lease, and then the creative side of understanding that market and all the dynamics of that building within that marketplace.
Yeah, I think that's a fairly new phenomenon, right? A new-ish phenomenon where everything is referred to as triple net. And certainly if you're fixing the roof, that's not triple net, right? That's not triple net at all, but they refer to it as triple net because I think it's there's a lot more triple nets in the past as opposed to today, where many of these the lessor is now getting wise to some of these things, and they want to really push that back onto the landlord, try to reduce their cost, essentially, of those rising costs you mentioned earlier.
I'll say another thing that's really interesting right now. Look, I got started in 2008, and interest CPI, for example, has been, it's been pretty steady, 2.5%, 3%.
The consumer price index, you mean, right?
That's right. And so we've seen this trend for the last couple decades because we haven't had high inflation. So our rent escalations are typically going to take place on an annual basis, or let's say every 5 years. Well, if they take place every year, for the last 2 decades, it's usually been 2.5% to 3.5% annual rent growth, like clockwork. Or every 5 years, it will go up by 10 to 12 to 15%. And then it'll kind of plateau and then go up and then step up again. Now that inflation is as high as it is, I'm really going to be interested to see if we go back to what was very commonplace in the 80s, late 70s, to where we had CPI clauses as far as annual rent adjustments. So I think this is kind of if I'm developing these today, I'd like to see, and I plan to hold them, I'd like to see CPI adjustments annually in the lease, or have some kind of mechanism to get stepped up in the event we continue to see higher, inflation.
Yeah,
which I think is a lot of what we've been talking about in the brokerage community is, is there a tipping point where it starts to go in that direction or not?
Right. I could have sworn there's a lease that we looked at recently. I know what it was. We were looking at acquiring an asset, and there was something in the lease that said if it exceeded a certain amount of store sales, that we would get some percentage of the sales or something like that. It was a very old lease. They don't do that anymore, right? Done more newer leases. But it's funny. The reason why I remember this one is because the store did not want to release her sales figures, but in the lease it says there's a dependency on the store figure. So it's like, in your lease it says this. So what exactly is going on here? But that's a whole other scenario, right?
Getting sales figures to me is like cheating. If I can get them, I feel so comfortable going into a deal.
Right.
I can back into all kinds of metrics to check on their performance. It's a very small world that we live in, right, Augustino, where, a lot of it's, I can call the master broker for Dollar G or some of these other groups and really kind of understand their business and how it breaks down. And so I know if they have a certain performance on sales versus what they pay in rent, if that's a healthy store for them, like one that they really like or one that they really don't. I've bought or had shopping centers under contract with grocery tenants, and it's like, show me their sales. And I could take a look at those and real quickly tell you we're going to either buy the shopping center or not, just based on that sales performance. So that's a critical piece if you can get it. And that's the hard part, if you can get it. What you just described, it's sometimes they want to keep that stuff under lock and key. Yeah.
I've heard of guys that tried to use cell phone data. Have you ever heard of that before? Well, what they'll do is you can look at a map and you can see how many cell phones go in and out of that spot. You can buy that data, right? So you're able to determine how many individual cell phones went into that location. And I mean, it's certainly not going to be exact, right? But if you can at least figure out, okay, let's say there's 100,000 of these things go in there in a single day, and each one of these people spend an average of $3. Okay, so it gives you a rough idea as to how that store would have done that day. Maybe $300,000 in sales that day. Okay, well, maybe it's a good deal. I don't know. I mean, but I've heard of those types of scenarios. I don't know where to acquire that data now because the data source that I had, I think they shut down, unfortunately. But there are other people that sell that same sort of data. But there are other ways to figure that out if you're unable to get your hands on the beautiful data, that many of these guys hold close to the vest now. I think at one point, again, a long time ago, they'd freely give it away, right? There was no problem with it. Yeah.
Yeah. I mean, it's interesting the world that we live in and how technology plays a factor. I do think having that data will be critical over the next couple decades. We know the retailers are using this now. I could reference a few kind of interesting books on how these individual stores, really kind of break down all the analytics from how to design a layout of a store that's going to be the most efficient to produce sales. Like this is we get into the marketing psychology side of these. These are really large companies that know their customer and know how to target them specifically. It's pretty in depth and fascinating if you get to see behind the curtain.
Yes, you know what? I love that stuff, but and I could talk about that for the next 3 hours, but better not. So I know you touched on a few things already about what information should be reviewed during a lease analysis. What other things should you be looking for when you're taking a deeper dive? Like, what are some of the gotchas that many people overlook when they're looking at a net lease property?
One that really easily comes to mind is the age of the property. So if you're buying an older property, you may have environmental issues. You may have code compliance issues. And what may trigger those code compliance issues is maybe your retailer decides they're going to remodel their space, and all of a sudden, oops, it triggers exterior ADA compliance. Or, hey, that drive-through that you've had for the last 30 years has been fine, but now it needs to be updated to code. And so you really have to understand those things. There's geotechnical reports, so environmental studies that need to be done on some of these sites. I mean, maybe it was a dry cleaner plant at one point. Maybe there was underground tanks from a previously used gas station. All of these things could extremely derail the property. So understanding the code, the zoning, understanding your parking counts, simple stuff like this. I'll give you a really fun example of a shopping center I bought 2 years ago that's actually performed really well. It's connected through an easement, or at least that was the way it was interpreted during the purchase, that we had access rights to use this drive-through lane. Come to find out, we did not. So we had to go to the neighboring property owner and pray to God and work with them and help them out on some other things just to be able to have that access right. Because, we ended up not finding that out during due diligence, because they basically said that, oh, yes, this is guaranteed and warranted and represented in the lease, in the PSA. So we thought we were, obviously clear. Title report came back, and sure enough, it was right there that, oops, we do not have access there. That's a huge expense. It's a huge time suck as well. And there's no guarantees that you can get it, and it's going to devalue your building. So we were lucky to actually pull that one off. I'm looking at another retail building. It's got a very unusual roof on it right now. Typically, what we see, especially over the last couple of decades, is it's a roof membrane called a TPO. It's a special kind of white sealant, almost like a plastic material that's very prominently used. Well, these individuals, looks like they put some kind of foam material over the top of a gravel roof. Well, that's riddled with all kinds of issues. So we're going to have to bake in as a reserve, eventually replacing that roof altogether, which is just a nasty piece of business that we're going to have to do. But it's what's going to be required. So it's understanding those little nuances about the property specifically. Lastly, we bought a deal. It was next to a Walmart, and it was a Walmart neighborhood center. So it's really important on these buildings to know what's happening in and around your property. If Walmart were to go vacant and it was replaced with some subpar tenant, right? Let's say like a trampoline park. We lose a lot of vehicles going next to our single tenant building every day, every month, every year. And, that just compounds. So it would greatly devalue our property 5-10 years from now, if that were the case. So we had to do some investigating with Walmart. Now, Walmart's not going to come out and tell you how they're performing, right? You can call the corporate line. They're not going to give you an answer. So we had to secret shop it. And we developed a relationship with the general manager. And again, he could not give us specifics, but he gave us the green light that store has been historically performing for the last 5 years above expectation, and that corporate's very happy with it. Now, that doesn't guarantee that they're going to stay there for the next 15 years, but it's really important you have that type of information going into a deal, because heaven forbid, if they were to leave day one when we bought that, we'd be in real trouble.
Right. Yeah, even those neighborhoods, I know what you're talking about, those the Walmart neighborhood stores. It's a smaller footprint. They have the green logo instead of the blue logo. They're fairly newer and modern, but I've seen those things go dark already. I've seen plenty of them go dark already. And yeah, you're absolutely right. And that's a very interesting way to look at it, because let's say, for instance, you're looking at an out parcel Dollar Tree. If that Walmart goes dark, which is the anchor, right, 500, 1,000 feet away, you're screwed. You're done, right? That store will get shut down. That Dollar Tree that you're buying will get shut down eventually.
Oh, 100%. Or they're going to want out, and then you're going to get a subpar tenant to replace it. Yeah, I mean, so you're not at the mercy, but you're closely tied with the performance of the surrounding retail.
Yeah. So, but to spend the extra time, the way you just said a second ago, spend the extra time to understand how that anchor tenant is doing is important. And when you're secret shopping it, though, I mean, you do eventually disclose, look, we're looking to buy this property over there.
I'm not doing anything unethical. Here's a good example. Walk into the store, this anchor tenant. How does it look? Is it merchandised well? Is the roof in good condition? Are the lights out? How does the staff look? Are they organized? So, what's the parking facility look like? Does it look disheveled? Usually it's a pretty good indication. If it's a good store, they're willing to reinvest and keep it looking nice. If it isn't, and this is so true for Dollar Tree and Dollar General too, go in and check out your store. Get a look for it. Is this a store that these guys are really happy with? I mean, if I see 10 stains on the ceiling tiles and lights flickering and the restroom looks a mess and the product's all over the place and it's not organized, it gives you an indication they're taking their eye off the ball and they're just not really that interested in this property. Now, if that was a top performer, that thing's going to look perfect. So if they give you sales, awesome. If they don't, just give it the eyeball test. Get a feel for it to see if this is kind of, if this is something that they're really thinking about and putting money into.
Yeah. Would you want to shop there? Shop there? It's
exactly.
Or are they maintaining it? Like, I think I've gone into a few of these stores personally where you look around at the ceiling and you do see those ugly brown spots, which is water, right? And they just leave the tiles there. They don't go ahead and replace them, right? It's very easy to replace a tile. It's not hard, but if they don't feel like they want to replace a tile, even tells you that they're not really dedicated to the spot.
Yeah, it's just not well run. And the reason why this becomes so important is their ability to pay you increased rent, which is what this game is all about, is highly focused or correlated to how their store is doing at that location on a sales volume perspective. So if their sales have increased 15% year over year and your lease comes up for renewal in 2 years, do you think they're going to want to stay? Oh, hell yeah, they're going to want to stay. And are they going to want to pay that increased rent by 15, 20%? They probably will do it. They won't be happy about it, but they'll do it. And that increase in NOI for you and us and for our investors is huge, right? Because that increase, and these cap rates trade so low, right? Just because they're in such high demand, that extra $20,000 a year on a 4.5 to a 5.5 cap, that's real money and real value creation.
Yeah, and I think one often overlooked scenario too is carrying a conversation with the cashier, the person at the front line, and it's not even, it doesn't have to be in depth. I remember speaking to one young lady. I was at a Family Dollar. This neighborhood was not a strong neighborhood, and I asked her. I said, "So how do you like working here?" And she's like, "I just started working here a week ago. I already hate it. I'm looking for another job." I'm like, "Wow, okay." So now it could be indicative of the manager making bad choices. It could be indicative of this individual. I mean, it could be a whole lot of things. It's one small conversation. But if you go in there enough times, you can figure out, okay, maybe this is not the right store, because if this is the type of people they're hiring, it's going to be the wheels are going to fall off this thing. right?
And
Eventually.
use what you know. There isn't a secret sauce to this business. We've all worked for companies, right? Like for most of us, not maybe you've been a serial entrepreneur your whole life, but you've worked with people in different groups.
Yeah.
You can usually tell by walking into the office, are people generally happy to be here? Is it a good environment and culture? You can pick up on these things. Just go in eyes wide open and to your point, just have a general conversation with someone. It may give you a nugget that's going to give you a leg up.
Yeah. That's right. So one thing you mentioned earlier, and I wanted to just touch on again, is that the specific areas of where these properties are located. I think one often overlooked space, I guess, when it comes to multifamily anyway, is what happens in that specific submarket, right? So, for instance, people in Akron, Ohio, if someone's buying a multifamily asset in Akron, Ohio, water bills tend to be extremely high because of some choices that were made by the city, I don't know, decades ago, right? I would think the same thing applies when it comes to these net lease assets, right? Because if and to your point about exterior views, or if it's not ADA compliant or whatever the case may be, those specific markets, like if you're buying a property in, I don't know, Westgate, Ohio, some smaller market, they specifically may be sticklers about what happens to that property, how it the look and feel of it. You have to be aware of those certain nuances, right? And if that's the case, how would you find that out? How would you figure that out on a due diligence perspective, anyway?
Oh, this is such a good question. I literally am building 2 pad buildings right now, so single tenant buildings right now. And one's in South Florida, the other one's in my hometown in Austin. I can't put the kind of signage that the tenants would want on them, right? And the reason is our sites are connected, and I'm under this like master agreement on signage. So I'm only allotted like this little baby monument sign that can only be a 4x4, right? It can't be the tall ones that we put up. And so how did we find out about it? Well, we really had to understand the zoning, and we dug into the zoning. We asked, look, I'm not a specialist when it comes to all these things. I don't have the attention span to read 40 pages of zoning, but it was clearly identified that our parcel was connected to this kind of master plan community section, which had all types of limitations on signage. And so that really hurt us, right? And it hurts the retailer. So one of my sites, I can't even put a sign on, right? The other one I can, but it has to be a certain type of stone and a certain color scheme. And it can't be this big, and it's got to have this type of size. And so you have to understand and kind of learn these things through zoning. And some of it you can literally call and talk to the city if you wanted to, if you had a question even. If I didn't have that specialist, I would have called them. Another one that I've run into is parking. Let's say you have a fitness facility that wants to take down your entire building. Okay, well, what's the parking that they're going to need on site? What's the zoning requirement for parking? Well, if it's, if they need 5 spaces per 1,000 square feet occupied, and your site doesn't have that, how are you going to solve that problem? It may be that you're going to have to talk with the neighboring property owner, which I've had to do, and pay for parking spaces and enter into a long-term agreement that matches the original lease with the fitness facility. So it's that level of detail and nuance that I find is you just got to dig in and kind of look at all these scenarios.
Well, we covered a lot of stuff here today, Jason, but I think we're coming up to that half-hour mark. So for someone listening right now, maybe they're thinking about getting into net lease, what sort of bulletproof advice would you have to offer them?
Learn lease language would be my first piece. Understand certain sections of that lease, read it, understand, go ahead and look at single tenant net lease properties if you're interested. Download the due diligence, read the lease. Read the lease and understand these markets. Understand the traffic counts, the parking to zoning. You're going to walk away with so much knowledge from just doing that exercise. It may take you 2 hours, but it's going to give you a clear perspective on how to evaluate things moving forward. There's a lot of really good books on lease language out there. I highly recommend a few of them. You don't have to read them cover to cover, but if there's a section in that lease that you're like, what does that mean? Google it, look it up, that's going to give you that knowledge that's going to make you bulletproof. So there you go.
Yeah. Well, I think investing too, even if you invest in some of these deals alongside some experienced folks that know what they're doing, that's a great way to get exposure
read a
as well.
REIT report. Those are great too.
Yep, that's right. Excellent. Well, good. All right, guys. Well, if you want to reach out to Jason, you can reach him via the contact page at libertyfund.io. Hope you got some insight on Net Lease. This is, there's still so many other questions I had, but it's like, it seems like we always run out of time, right? But who knows? Maybe we could do this again. We'll go even deeper on the Net Lease stuff, right? So we'll see how that goes. Yes, excellent. All right, guys. But in the meantime, thanks for tuning in. Take care, and I'll see you in the next one.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.